earnings season, and we continue with that first up.
We do that as well. So let's get across to Tarun Mehta, the co-founder and CEO of Ather Energy, joining in with what was a very healthy third quarter for the company operationally. We'll be discussing, obviously, the following talking points. One, visibility on margins, whether they turn positive or not, market share target by the end of this financial year, the next financial year, and the impact of higher commodity prices. Let's attack two of them. First up itself, thanks a lot for joining in, Tarun. You know, it's been a phenomenal improvement that you've shown in your operating performance, where the losses have narrowed. The reported EBITDA margins are now just -3%. That's an over 1,500, 1,600 basis points improvement. While this has happened on account of increased volumes, improved market share, and increased productivity gains that you got as well, on the other hand, there is this risk of higher commodity prices that may impact your operational performance. So how do you balance these two? By when do you turn EBITDA positive, reported EBITDA positive, and are you taking any sort of price hikes?
Right. So thanks. Yeah, Q3 was a great quarter for us. We saw a 50% growth in volumes. We saw 1,500 bips improvement in EBITDA. We also saw a good improvement in unit economics by almost 300 bips. This was honestly firing on all cylinders. Unit economics improved because we were able to improve our ASPs, because we were able to drive costs down. And operating leverage was there. We have roughly 4x our volume in the last 6 quarters. So that's kind of played out beautifully in the EBITDA journey. We've cautioned that there are some headwinds potential from commodities in the coming few quarters. And what we've done for that is obviously kept a lot of our engineering bandwidth focused towards cost reductions, but also keeping a tight control over our fixed costs. We want to fast track our journey towards break even as much as possible, so that even if we absorb all these blows, we land up at a better place and stay on a good path.
So by when do you break even? By when do you break even?
Always difficult to say, and we don't give a guidance there, but we've gotten pretty close, and we intend to stay.
That's the worry, right? You've gotten pretty close, but the other side, the commodity prices have taken you far away from there. So with all things said and done, maybe, okay, not a particular quarter or any sort of guidance, but any time in the next 3 or 4 quarters, is there visibility for you to break even?
So we've got a few growth levers ahead of us. First, on price hikes, we took a 3,000 rupee price hike just at the start of Q4 itself. That's with the intention of absorbing some of the potential commodity hits here. I think that'll go a long way. We have further cost reductions coming our way. The biggest one ahead of us this year is coming from a transition to the low-cost scooter platform, the EL scooter platform. So between both of these, we expect a lot of gains ahead of us. So we think we should be well positioned to absorb these hits. Thirdly, our software contribution and our non-vehicle revenues have been on a tear. So we had almost 14% of our revenue coming from non-vehicle sources, a large majority of that coming from software sales. So that's continuing to support our P&L massively. And we think this trend will likely continue, given what we have seen in newer markets, particularly the northern markets, where the trends have been very encouraging.
Right. So just 2 questions before we let you go. A 2-part question. You can give us numbers. One, your market share by the end of this year, where does it stand? It's about 18.8% right now. What's your target there? And by the end of FY27? And non-vehicle revenues, which is about 13%. You said directionally that is increasing. So from about 13%, where does that go on your market share? And your non-vehicle revenues, if you could give us 3 quick numbers.
So market share, think of this as 2 different parts of the country. In South, we've been consolidating at 25% market share now for several quarters. And with the current portfolio, we are pretty confident of this. In the rest of the geos, we believe our fair market share lies around 20%. And we've been moving towards that every quarter. So a 20%-ish, 20% plus kind of a market share is our near-term expectation. And on the other question was around
non-vehicle revenue.
Non-vehicle revenue. So that's compounding really well. So there are 2 parts. Software sales, we've been able to hike prices of a software also consecutively over every year. But service revenues are compounding in nature, given the fleet size. We believe in steady state, there is a 3 to 4% potential improvement from this source. So the current 14% could compound to 17, 18% over the next few years, driving a lot of margin gains for the business.
Tarun, thank you so much for sparing time and joining us today. Wish you good luck for the rest of the quarters as well. The management there of Ather Energy.